Hello, friends. If you're learning trading, then understanding multiple time frame analysis is extremely important. However, many beginners either ignore this concept or use it the wrong way. As a result, they end up taking wrong entries. Their stop losses get hit repeatedly, and they start believing that their strategy doesn't work. But in reality, the problem isn't the strategy, it's the way they analyze the market. In today's video, we'll understand multiple time frame analysis in the simplest way. We'll cover what is multiple time frame analysis, why it's important, which time frames you should use, how to analyze the market step by step, and how professional traders use this technique to find high probability trading opportunities. By the end of this video, you'll clearly understand why professional traders look at the same chart on different time frames and how this improves their trading accuracy. So, let's first understand what multiple time frame analysis actually is. In simple words, multiple time frame analysis means analyzing the same market on different time frames instead of relying on just one. This is important because every time frame tells a different story about the market. There are mainly three types of time frames: the higher time frame, the medium time frame, and the lower time frame. The higher time frame shows the overall market direction, the medium time frame helps you identify a trading setup, and the lower time frame gives you a precise entry. Now let's talk about which time frames you should use. If you're a scalper, your higher time frame can be the 15-minute chart, your medium time frame can be the 5-minute chart, and your lower time frame can be the 1-minute or 3-minute chart. If you're an intraday trader, you can use the 1-hour or 4-hour chart to identify the overall trend, the 15-minute chart to find the setup, and the 5-minute chart for your entry. And if you're a swing trader, you can use the weekly chart to determine the overall trend, the daily chart to identify the setup, and the 4-hour chart for your entry. Remember, the exact combination isn't as important as understanding the role of each time frame. The higher time frame tells you the direction, while the lower time frame helps you enter with better precision. Now, you might be wondering, why isn't one time frame enough? Let's say you're only looking at a 5-minute chart. The price appears bullish, so you decide to enter a buy trade. But if you had checked the 1-hour or 4-hour chart, you would have noticed that the overall market is actually in a strong downtrend, and that bullish move on the 5-minute chart was nothing more than a small pullback. After a while, sellers step back into the market, the price starts falling again, and your stop loss gets hit. This is one of the most common mistakes beginners make. They focus only on the lower time frame and completely ignore the overall market trend. And that's why multiple time frame analysis is so important. Now let's understand the complete process step by step. The first step is higher time frame analysis. Open your higher time frame chart and identify the market trend. Check whether the market is making higher highs and higher lows or lower highs and lower lows. If the market is in an uptrend, focus only on buying opportunities. If it's in a downtrend, focus only on selling opportunities. At the same time, mark important support and resistance levels, demand and supply zones, or order blocks. These are the areas where the market is most likely to react. The second step is medium time frame analysis. Now switch to your medium time frame and observe how the price behaves around those important higher time frame zones. Is the correction coming to an end? Is the market forming a breakout or a reversal pattern? Is the trend likely to continue? This is where you identify your trading setup. The third and final step is lower time frame analysis. Now move to your lower time frame and wait patiently for confirmation. Your confirmation can come in many forms, such as a market structure break, a breakout and retest, a bullish or bearish candlestick pattern, or any other confirmation that fits your trading strategy. Only after getting proper confirmation should you execute your trade. When all three time frames align in the same direction, that's when your trade has the highest probability of success. This approach allows you to take planned, high-probability trades instead of random entries. Now let's understand this with a practical example. Suppose you're analyzing XAU/USD, which is gold. First, you open the 4-hour chart. You notice that the market is consistently making higher highs and higher lows, which clearly indicates an overall bullish trend. At this stage, you decide that today you'll only look for buying opportunities. You also notice that the price is approaching an important demand zone from where the market had previously made a strong bullish move. Next, you switch to the 15-minute chart. Here you notice that the price slowly enters the demand zone, selling pressure starts decreasing, and the market begins moving sideways. It looks like buyers are gradually taking control again. This means both your higher time frame and your medium time frame are pointing in the same direction. But a professional trader still doesn't enter the trade. Instead, they wait for confirmation. Now you switch to the 5-minute chart. After some time, the market forms a small bullish market structure break, followed by a successful retest. Soon after that, a strong bullish candlestick pattern appears. According to your trading strategy, this is your entry confirmation. Now you execute the buy trade. You place your stop loss below the recent swing low, because if the price breaks below that level, your analysis would be invalid. For your target, you can use the next resistance level or simply follow your preferred risk-to-reward ratio, such as 1 to 2 or 1 to 3. Now just imagine, if you had looked only at the 5-minute chart, you would probably have seen just another breakout. But because you used multiple time frame analysis, you understood the complete market context. You already knew that the overall trend was bullish, the price was reacting from an important demand zone, and the lower time frame had also given a bullish confirmation. That's why this trade had a much higher probability of success. And that's the real power of multiple time frame analysis. Now let's look at some common mistakes that almost every beginner makes. The first mistake is getting confused when different time frames show different directions. Always give priority to the higher time frame for the overall market direction. The second mistake is entering a trade without waiting for confirmation on the lower time frame. Never enter a trade just because the price has reached a zone. Always wait for confirmation. The third mistake is using too many time frames. Some traders check everything from the 1-minute chart to the monthly chart and end up completely confused. Stick to just 3 time frames and practice with them consistently. The fourth mistake is trading against the higher time frame trend. Counter-trend trades are much riskier, especially for beginners. Remember, multiple time frame analysis is not a magic trick that guarantees profitable trades every time. Its purpose is to help you understand the market better and avoid low probability setups. When you combine the higher time frame trend, the medium time frame setup, and the lower time frame confirmation, your trading decisions become much more logical, disciplined, and consistent. So the next time you're about to take a trade, don't rely on just one chart. First, understand the trend on the higher time frame. Then identify the setup on the medium time frame. Finally, wait for confirmation on the lower time frame before entering the trade. This simple process can significantly improve your trading accuracy and help you avoid many unnecessary losses. If you found this video helpful and now have a clear understanding of multiple time frame analysis, don't forget to hit the like button, subscribe to the channel, and press the bell icon so you never miss future videos. I'll see you in the next video with another simple and practical trading lesson. Thanks for watching.